Welcome and good afternoon. Thank you everyone for joining us today. On behalf of Legg Mason, it is my pleasure to welcome you to Outlook 2011, which we're calling Striking the Right Balance. While we've certainly seen improvement in the economic picture in recent months, there's still a good deal of uncertainty about the pace of recovery and how investors can best prepare for the year ahead. So we thought, why not bring together some of the brightest minds at Legg Mason to share their perspectives on how to strike the right balance between risk and opportunity in 2011. To get us started, I'd like to introduce an individual who really does not need much of an introduction, Consuela Mack.
Professionally, it's been fascinating for me to follow how Legg has grown over the last 4 decades from an excellent regional firm to a top-notch global money manager. First, under the leadership of Chip Mason and now Mark Fetting, Legg has assembled a collection of best-in-class investment firms and portfolio managers, 4 of whom are in front of you today. And what is particularly remarkable is that each of their firms excel in their chosen areas of expertise and maintain their autonomy and independence of thought. And that independence is going to be very much in evidence today.
It's critical to have a view about how the Fed is doing what they're doing. I take a little bit different view from Hirsch on this, and maybe follow up on something Steve said. One of the things that Steve said was, a month or so ago, 3.5% would be optimistic. Now it's consensus. The general trend of the economic data, not all economic data, but the general trend of the data is higher. And that's because, as Hirsch mentioned, the stock market's up. So the stock market is not only a leading indicator, it's causative in the economy. People feel wealthier, they spend more money.
What does it tell you about the economy that the Federal Reserve is telling you that they're going to keep interest rates at 0 for an extended period of time? It tells you what I think, which is they don't think the economy is out of the woods. They think there's still significant risks.
If rates were to rise, more strategies in Western assets portfolios would succeed than be hurt. Because of our overweight to credit, the credit markets and high yield, those sectors would likely do well. I think we'd all agree here, if rates are higher a year from today, it's probably because the economy did better.
I think the other 2 important economic sort of factors are capital spending, which I believe will pick up, and the stock market. Stock market is a closed loop of spending, a very critical thing. That is one of the reasons why economics are picking up rapidly.
With the U.S. economy doing relatively better, with Europe being sort of a tale of 2 economies over there, but a lot of sovereign risk in Europe, inflation problems coming up very significantly in China and India, where tightening is underway. The U.S. is in a relatively stronger position and a better position, I think, than most people realize.
Meanwhile, the economy has plenty of pockets of strengths. In the companies we favor, higher quality, smaller companies, we're seeing much stronger returns to profitability and margins than we would have thought. It has been outstanding, and overall there is economic strength which I see building for some time.
Dividends on a random portfolio went up over 5% a year. On our managed accounts, they were up over 9% a year compounded. That's pretty good. That's a double every 8 years. My guess is there's plenty of room for that to happen going forward as well. So dividends really do make a difference. People, where else can you get a raise every year?
So I guess we kind of embrace the thought that, well, there are great opportunities in stocks, I would agree. But if these gentlemen are right on stocks, that it's a good opportunity for corporate America, high yield bonds are going to do very well also, because that means balance sheets are good, businesses are good, people are paying debt. So we think there are still a lot of good opportunities in fix, even given the risks that exist out there. But again, it would be away from maybe the Treasury market.
Great long-term advice from all of you and great short-term advice from all of you as well. Thanks so much. And this is a discussion you never want to have end, but unfortunately we must end it. And so on behalf of Legg Mason, we want to thank all of you, our participants, for helping us strike the right balance with this thought-provoking session for investors. And our thanks to everyone online and on the phone who took us the time to join us today, and also most especially to the panelists. Thank you all so much.
Thanks. Thank you.